A few weeks ago, there was an interesting development in Mrs. Bector Food. Sunil Singhania's Abacus investment picked up nearly 1% stake in the company at around 169 rupee per share through a block deal. And what happened after that was quite interesting. Its stock started seeing strong buying along with sharp increase in volume. On Friday, company also declared its Q1 result and stock jumped around 7%. In fact, over the last 1 month, the stock is up around 35%. However, even after the sharp recovery, the stock is still down 47% from its previous high. So the question is, what suddenly changed in Mrs. Bector? Well, the company has gone through a roller coaster ride. Between June 22 and September 24, stock price increased more than 8 times. But then, stock corrected almost 60% from its peak. However, from the recent price action, can we assume that the worst is over for the company? To understand this, we first need to understand the business of Mrs. Bector Food. Then, why its stock tanked 60% from the peak. And finally, we'll look at the latest Q1 FY27 results and management commentary to understand whether the business is actually showing signs of recovery or not. The key is to understand one simple thing. Is Mrs. Bector's story actually turning around or is it just a temporary jump? As usual, this video is not a buyer side recommendation. If you are here only for tip, you can skip this video. Many retail investors have this habit of not taking any ownership of their investment. They simply invest based on tips and then blame others for their failure. See, it's your hard-earned money and you should have the right knowledge before investing it. If you don't know stock investing, then first learn it. Build your investment foundation and then invest. Alright, let's get started with today's video. So Mrs. Bector is basically a food company with two verticals. First is biscuit business. Second vertical is bakery business where English Oven is the main brand. Now the interesting thing about Mrs. Bector is that it is not only selling its product to consumers through retail store. It also has a large institutional business. For example, if you go to McD, KFC, Burger King or other QSR chain, the burger bun that you get can actually be supplied by Mrs. Bector. Now let's understand why its stock price tanked around 60% between 24 till 26. So first reason was slowdown in growth. Its biscuit business became highly competitive and bakery business also went through difficult period. And the institutional business, that is QSR segment, also slowed down. So the revenue growth that was 36% in 23, 20% in 24, slowed down to 15% in 25 and 9% in 26. At the same time, company was dealing with raw material inflation, packaging cost, fuel cost and wage inflation. So you had a situation where revenue growth was slowing while costs were increasing. That obviously put pressure on margins. As a result, its margin fell down from peak of 14% to 12%. And then there was another problem. The company was continuously investing in new capacity and distribution. But the benefit from those investments were taking time to come through. So the market started asking a simple question. If growth is slowing and margins are under pressure, why should we continue giving this company a premium valuation? And once expectation came down, P multiple also contracted. So at one point, its P jumped to levels of 100 and then cooled off by more than 50%. Now that's an important point. The stock did not fall 60% because the business suddenly became bad. A big part of that correction was that the market has priced in very high growth and the actual growth and profitability did not meet those expectations. Now the question is, what is happening now? I think there are a few important things happening at the same time. First is recovery in bakery business. So bakery revenue grew around 18% in Q1 and more importantly, management said the institutional or QSR business is now showing a clear recovery. This is important because Mrs. Bector supplies product to large QSR chain and this business had gone through a weak phase. So if QSR demand continues to recover, this can become an important growth driver for English Oven. Then second driver is distribution expansion. Management want to add around 40,000 build outlet this year, which is roughly 12 to 13% increase in its distribution network. And this is important for consumer business. Once you have the manufacturing capacity, getting the product into more outlet can drive growth without requiring a completely new business model. Then third driver is capacity expansion. Company has already started operations from its Kolkata bakery facility, which is helping it enter the eastern market. Then Khopoli plant in Maharashtra is also stabilizing and moving towards higher utilization. And now company is planning a new plant in Bangalore with around 200 crore of investment because it currently is facing capacity constraint in South India. So company is not just waiting for demand to come back, it is actually preparing capacity ahead of that demand. Then fourth driver is international business. Export delivered healthy double-digit growth in Q1 and US business has started growing again. Company is also launching new products in US, including peanut butter cracker, and expanding its product range with large retailers. So this can become another growth engine over the next few years. And then we have premiumization and new products. Company is pushing premium cookies, creams, shortbread, and other higher value products. It has also launched Nature Baked, its clean label offering, which has currently reached around 1 crore monthly revenue run rate. It's still very small compared to overall business, but if categories scale, it can also improve the overall product mix. Interestingly, company's management is targeting 14% EBITDA margin by Q4 FY27 and has a longer term aspiration of 15-16% by FY30. And this is where I think the operating leverage story becomes interesting. You have revenue growth coming from distribution, bakery recovery, exports, and new capacity. At the same time, you have margins improving through premiumization, cost efficiency, and better utilization of existing manufacturing base. So if both things happen together, that is revenue growth plus margin expansion, then earnings can grow much faster than revenue. And management is quite ambitious here. Company wants to reach 4,000 crore revenue by FY30 compared with around 1,900 crore revenue in FY26, while taking a EBITDA margin to 15-16%. Now, whether they actually achieve this is something we have to track over the next few quarters. But at least for the first time after a difficult couple of years, the growth story and margin story are starting to move in the same direction. And that, in my view, is the biggest change in Mrs. Bector's story. If you look at the shareholding pattern, its promoters slightly reduced stake in September 24 quarter, but since then it has remained constant. Although FIs have remained net sellers, but DIs continue to accumulate Mrs. Bector food every single quarter. And recently, buying from Sunil Singhania adds more credibility to company's performance. So coming back to previous question, is the worst over for Mrs. Bector? Although I think it's still too early to say with confidence, but clearly the business is showing some encouraging sign. The biggest positive is that growth is coming back across biscuit, bakery, export, and institutional business. At the same time, margins are improving and management is targeting further margin expansion over the next few years. So the next phase of story is not about revenue growth only. It is about whether Mrs. Bector can deliver double-digit growth while simultaneously expanding margin. That's what can really change the earning trajectory. But there are still risks. Commodity inflation can come back, competition in business remain intense, and companies investing heavily in new capacity. So we need to see whether these investments generate the expected return or not. For me, there are three things I'll be tracking over the next few quarters. First, can companies sustain double-digit revenue growth? Second, can EBITDA margin move towards 14% target by Q4 FY27? And third, can the new capacity and distribution expansion translate into strong growth without putting pressure on return ratio? If the answer to all three questions is yes, then I believe the worst is over for the company and there is good upside potential. But let me not stress this video. Now you tell me in the comment, is Mrs. Bector looking interesting at current levels or not? I'll see you next video. Till then, take care.